first one is selling really, really good businesses too early and thinking that stocks are overvalued that have got structurally strong tailwinds and structurally good business models and then have this structurally strong cash flow and dividend profile, because the compounding effect is missed. And I see CSL as a classic example of that. I mean, looking at the history of the share price and what the yield would be if you'd bought that stock at, the float at, I think it was $2 is what it was, but same with Macquarie Bank, it's the same sort of argument. So that's the first lesson. The second lesson is trying to use yield as optically high yield as a major part of your selection process, because as I mentioned before, the rate of disruption with business models and the dividend cover that's now prevalent with a lot of these names and where payout ratios are, there is very, very little cushion to be able to sustain or grow the dividends when the earnings come under pressure, because of those changing conditions. And the third one is be very wary of picking cyclical turnarounds if the businesses haven't got, again, a really good position of strength in what they're doing. So, I might envisage a time where I might own some resource stocks. Now, if I look at BHP and Rio, they've got really, really strong market positions, and so you can look at their sustainability a lot more favourably than just perhaps a small retail cyclical stock which has got no real competitive advantage. I think probably one of the biggest lessons I've ever learned is, don't sell your winners too early, because they'll keep on delivering if the business models are there, and they'll compound and they'll deliver you, very, very successful returns over the long term.